just after 3 p.m. each time. Happy May 1st, kicking off a new month. We had a pretty wild close to April, and we have non-farm payroll tomorrow. Take a look at the data that came out today. Markets are up with mostly a gap higher. Price has actually been pretty quiet all day. And we'll see how the final, 45 minutes treats us. So the tagline here, the thumbnail, economists and bets align. I've got some interesting data to share. Let me find a couple stats here. So Meta and Microsoft news overnight. Take a look at their stocks. Both beat earnings top and bottom. Both are spending a lot of money in the AI space. Both are pretty much trying to create a moat in the AI space. Expected earnings growth by sector. This would mostly be still in tech. This is expected earnings growth over the next 12 months. Tech still has the highest, then followed by healthcare, communication services, industrials. Let me take a screenshot of this. I think this will be important to share. So expected growth by sector. Have a look right here. So that screenshot, if you can see it, let me see if I can make this a little bit larger. There you go. So tech sector still expected to grow by 18.1%. This over the next 12 months. Least amount of growth will be 3.1, real estate 3.3. Even though real estate's outperformed the entire financial markets the last 17 years. Discretionary 5.3, utilities 7.4, financials 8.3, S&P 500 10.9. So earnings growth, where is it? It would be in tech. You got to wonder though, is it large cap tech? Is it mid cap tech? Is it small cap tech? Based on what we saw this week with Microsoft and Meta, large cap is still hard to argue. Okay, what else do we have? U.S. contracted for the first time since 2022. That was a negative GDP print. You had Trump going the 100-day in office celebration, blaming the Biden administration that it was his stock market, not Trump's. There's a lot of spinning and jawboning happening right now. Here's what I wanted to talk about: the prediction markets. Show you right here. Prediction markets agree with Wall Street. Trump's economy is faltering. Thought this was interesting today. Recession this year. So in recent weeks, Goldman Sachs, Morgan Stanley, UBS, JP Morgan, all have cut GDP forecasts, all increasing their recession odds. And then on Tuesday this week, rare moment of consensus, prediction markets locked into the same outlook as the old guard. So on the betting platforms, Call Sheet Poly Market, odds are U.S. recession this year spiked to 65% from 55% the day before. And this is crazy because these betting markets were only around 18% recession probabilities going into Inauguration Day. So a pretty wild run as far as consensus is changing. This is old guard and new guard lining up. I thought this was something to take note of. It's like, I know that the market usually it's very good at kind of navigating the pain trade. And right now, if big financial investment firms and big banks are calling for recession odds to increase and calling for a weakening U.S. economy, I don't know what their horizon is. Nobody knows, right? They can talk about it. They can talk about it. They can talk about it. It probably will be like the stock market may have already priced in a bit of it. I don't know if it's priced in all of it. It certainly hasn't been hit by earnings compression. The S&P, if you look at the S&P forecast, they're still up to new highs. Q3, Q4 for the S&P is still looking at earnings growth this year. So, the negative GDP print, it's not as downbeat as what we saw a month ago when everyone's worried about, the Atlanta Fed talked about a negative 2.5 GDP. The U.S. economy performing. This is the first time since 2022 we've seen a negative print. The average post-election year, this is a pretty rough path considering you go all the way back to 1950. The light blue line, if I zoom in on this, the light blue line is the average S&P performance even through a post-election year. Right now we have had, and I mean, this looks like, it's not that bad. It's like we were down 20%. It was that bad. April finished 1 month off of the open to the downside. April was a negative 1% month, which could have been a lot worse and certainly was a crazy volatile month. We had one of the biggest spikes that I've seen in the S&P since COVID. March's COVID was essentially April's 2025. It was a wild and crazy move. COVID actually was bigger. March in COVID was March 2020 was a 900 plus point candle on the S&P. And I think this year it was 800, 820, 850 points. It was a wild, volatile week. And here you go. So start, stop, fashion, blah, blah, blah. So anyway, just thought all this is interesting. So I want to share it. and we will see how it all plays out. I keep going back to, the markets. I think the best thing to be able to do is to be able to trade through this. That is the name of the game. Is like you got to find a way to trade through this. That's the only thing you can do. So where do we go from here? Well, we did today with the gap up in Microsoft and Meta, which have both moved really nicely. I closed out a winner today on Meta. Glad that I took the profit. Closed out a winner today on Microsoft. Glad I took the profit. Microsoft blew out earnings, and the market. I think we expected. Look and see what options we're supposed to price in. I think I posted it in my chat here. So Microsoft. We expected to see a Microsoft earnings move of about 4.5%, and it ended up jumping about 8%. So that was double what was expected. I mean, it moved up 9%. And that's where it's currently sitting. I mean, from this level to the high on the day, we were up 10.5%. I mean, last time I checked, 10.5 with an expected move of 4.5. That's a 233% blowout in earnings compared to what was normal, which is good. I think this also is a bit of a sneak peek to what earnings can give us this year. Is good news is good news. I think the market's going to run with it. Bad news could be terrible news. The market might crush it. It just depends on where these stocks are at. I mean, Meta was a little bit better than expected. I was looking at Meta producing about a plus minus move of 10%, and we went up around 7.92. But I priced it out accordingly where we still made money on the trade. So I closed out my Meta trade today for about a 30% winner. 30% winner, yep, 30.2%. And then Microsoft we closed out for 84.6%. Not too shabby. Hey, Christian, how are you? Donna, good afternoon. Hey, Sam. Watford says thoughts on Apple. I can look at it. We have earnings after hours. Usually Apple is pretty tight in earnings. It usually is pretty tight. So expected move, dude. Oh my god. Let me get logged in here. Actually, give me 1 second. I'm looking to see what the earnings history has been on Apple. Usually Apple's not an explosive mover, but that can change. I mean, we obviously can come up to Apple and fill the gap. It's just not that far away. It's only about $9 higher. We go to earnings history, about 4.48%. That's been really, really consistent. So I know that they just lost a big lawsuit with Epic Games, which means they're kind of losing a bit of the control they've had in the Apple Store, or the App Store rather. So 4.45%. Current price on Apple is what, 212, 212.73. So oops. So 0.045 times 212.72. We're looking at about a $9.50 move on Apple. So how many times does Apple at least get to 4.5%? With earnings today, how many times do we get to at least 4.5%? If we went out to next Friday, I mean, one thing that might be interesting is how many times in one day do we get to 4.5%? And it depends on what type of premium I can get for it. So we have that's over 4%, that's over 4%, that's over 4%, that's over 4%. So if I wanted to like put in an iron butterfly where I can sell premium at the market, if it blows out above or below, then I'm going to lose on that side. If it's this, like Apple would be great if it was a non-mover, So anyway, if it went out a week, I give myself a little bit more time. But let's find out. So how many times do we get to 4% in 8 days? We get there day 8, which is kind of crappy, but it still got there. We don't get there here. We don't get there. Actually, we did get there day 5. Gets there right away. Does not get there. Gets there at the very, very end. Does get there right away. Does get there right away. Does not get there. Gets there right away. Gets there at the end. Doesn't get there. Does get there. Doesn't. Does not. Does not. Does. In typical fashion, I mean, it gets there most of the time, like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 yeses. So we have 12 times it gets there. 1, 2, 3, 4, 5, 6, 7. 7 times it doesn't. So you have about a 60% chance. About a 63% chance that it hits an expected move. So if I want to position on Apple, take a look at it. Apple for next week, if I want to go out to a week and see how this will play out. So if I wanted to go out about, this is looking for about an $11 move. This actually is okay. Like the IV looking for a 1075 move. My calculation at a 4.5% times a 212.60 stock. I mean, I'm only looking for the average earnings to go about 9.56. So this is a little bit higher volatility. Something tells me that maybe the better trade would be this. If I sold more premium and then went, see if I can go 10 wide here, what it would cost me. 210 by 220, 215 by 205. So I get 876. What's that as a percentage move? 8.76 out of 212.65. I get about a 4% buffer. So if we move 4% or higher, I would lose on the trade. It's a low risk. I mean, the most I can lose on the trade is $124. I mean, that's not a bad way to trade it if I wanted to take this trade by tomorrow. Actually, that's going out to next week. Let me put a pin in this trade real quick. Let me go back to the second. So tomorrow, let's say that I sold, oh yeah, $8 move. I'm not going to get a premium here. If I sell 210, so sell the 210, sell the 215, and go 10 wide, 15 to 5. So I'd get $8.50. So 850. 849 divided by 212.67. So if Apple moved 3.9% or higher, I would lose on the trade. So it'd have to move 3.9% immediately at the open, which is doable. Obviously, I don't know if it's going to be a contained price, but if we went up 3%, 3.9% means Apple would have to jump up here to 220, or Apple could fall down to 203. I almost think it's a little bit better. I'm going to try to put the same type of risk profile where I don't have a lot of risk on the trade, but let me do like the 217 by 220 and that's only up $5. So let's go up 750 here and then the 205 by 202.50. I'll take this trade. I'm going to take a trade on Apple here for $1. This is out to the second. Oh fudge, I want to go out another week. Yep, I'm going to go out to the next week. This might be a bit more expensive, but a 220 by 222 and a 20. So that is up 750 and then 205 by 202. So $1.38. Is it a little bit better if I go wider? It's going to cost me more. This is about a 1-to-1. I don't mind this trade here. I'm going to get into it for $2.51, hopefully. Let's see if this plays out. I'm going out to the 9th. So Apple most of the time hits the expected move. Let's see if this one plays out. So 251 pending order, 252 pending order not filling, 253 is near the ask price, filled at 252. Okay, I'm going to send this one out for newsbreakers. 5/9 expiration. Buy the 220 call, sell the 225 call, buy the 205 put, sell the 200 put, $1, $2.52. Debit, 252 max risk, $5 max credit. Expected move is plus minus 1073. Average move is 4.5% or around $9, about $9.57. Okay. These are $7.50 out of the money with about a 63% chance of Apple hitting the expected move. Okay. So I like the way I priced it out. I'm going to put this in the tracker and see if we can hit an expected move by next Friday on Apple. So a 5/9 expiration. Today is the 1st for the entry date. $220 call. 205 put. Okay, 252 debit. So that's my trade on Apple, Watford. I'm taking it both directions. I'm going to see if Apple can move at least 750 one way or the other. So I need price to get up above about 222.50. So 222.50 right in there, or down below 2. Oh shit! Hang on. I think I took the wrong. Nope, I got it. I meant to do a 200. I did it right. I just typed it incorrectly in my. Okay, let me make sure I sent the alert out correctly. Okay, I got it. It's fine. So it's a 220 by 225 call spread and a 205 by 200 put spread. I typed it in incorrectly. So anyway, I've got 252 debit. So my max risk is 252. My max credit would be $5, which gives me nearly a 1-to-1 if I'm right. So anyway, I need this to go down to 202.50. So if we get the 202.50, we can make some money. If we go up above 222.50, we can make some money, and we'll see what happens. This is out to next week. All right, that's Apple. Amazon is the other one. Let's take a look at Amazon really quickly. Amazon is up on the day. Amazon's had a pretty interesting week. It's been pretty volatile with Meta and Microsoft. You know, there's could still be some room to the upside. I mean, this high to low, we could spend some time pulling back. I mean, I'm as curious as everyone else. Like, are these markets going to make all-time highs again? Are we going to get into some consolidation here? So, I mean, it's just an earnings play, so it's kind of a one-off. But let me just price out Amazon really quickly and see what this one does. So Amazon for earnings history, we move about 7.6%. You can see a lot of these in the double digits. I think that's a safe one. I'm going to go 7.5%. 7.5 is the expected move on average. Price on Amazon 191.50. So I'm looking at about a 1436 move. 1436 move. Brokers are looking for something. $11. So I'm expecting about 14. Brokers are planning in 11. I think they're underestimating volatility. If I go out to next Friday, $13 move. Now I need to see how many times in 8 days this will actually go to my expected move. So how many times in 8 days do we hit at least 7.5%? Let's find out. And if it's not very often, then maybe I sell the premium. So this one didn't get there. This one gets to 11 on day 8. This one we hit 7.5 right away. This one we hit 7. It's not there, so no. This one hits it right away. This one hits it after day 5. This one gets it right away. This one does not get there. This one gets there right away. Right away, right away, right away, right away. Doesn't get there. Does get there. Doesn't get there. Doesn't get there. Doesn't get there. Does not at the very end. So I'll stop there. So it looks like it's about the same. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 times. So we have 14 yeses and 1, 2, 3, 4, 5, 6, 7, 8, 9. And we have 9 no's. So 14 out of 23 times. So about a 61% chance we get the expected move. Again, I think we're a little bit heightened on earnings sensitivity. So let's find out. I think it's worth trading the directional side of it. So I'm going to try that. See if I can price it out. So I'm looking for a move of around $14. Market maker's looking about 13 a week out. I'm going to try to price in $10. So 191. See if I can do like a 200 by 205. That's not terrible. And then a let's go 82. Let's go 182. That's a little bit more expensive than I'd like it to be. Let me see if I can go a bit wider. So I'll go 5 wide here. Now it costs me 270 to make 230. Bit more expensive, but not a bad trade. This is if we get an expected move that's pretty decent. I'm paying about 20 cents more than I did on Apple. Ivy ranks a little bit higher, so it's probably where the premium comes in. As far as reward to risk, this should be better. If I get 227, get about an 83, 84% max profit here. If I go down to a 250 spread, I'm probably getting less. About a 70%. So I'm going to go 5 wide on this one. It's going to cost me another dollar or so. So hopefully 270 to 275. I get filled at. Let me try this trade here. Let's try a 271. Let's try to get filled right at the mid price. This is out to the 9th. Didn't get filled. So 271 is not filling. 272 got filled. All right, I'm in. Newsbreakers. That's a 200. A 182.50 put. So $2.72 debit. Max risk, $5 max credit. Expected move, plus minus 1306. Earnings, average earnings move, plus minus, I think it was 7.5%. $7.5%, or price wise should be around $14. About $14.30. Amazon hits the expected move around 60% of the time. And I'm in. So we'll see. 38 Amazon. Today's date. So buy, 200 call, 205 call. $72 debit. All right, see how that prices out. So Amazon, just a one-off trade. Can we get to basically 203? We get to 203, that's a break even. We get to 179, that's a break even. So right in there, if I zoom in on the daily, there. 179 break even, 202 and change, 202.70, 203. So I'm just going to make this a 203. 202.72 is my break even. Move this over, and we'll go 179.30. $3 would be 179. The heck? I think it's 179. Why can I not do math right now? 179.80. There we go. Okay, so for above or below, another grab there on Amazon. So Apple, Amazon, Airbnb, want to check this one out as well. We're trading at 124. This one has earnings after market. This one is pretty sensitive to earnings. I thought about taking a trade in this one. I mean, I like the stock overall. I think fair value in this one is like 140, 130 or 140. 28 times 5 price to earnings, fair market 258 versus peers. I mean, it's cheaper than most of the hotels. I don't know if this is going to be a good earnings play or not. I would almost, I don't know. Part of me almost want to go out further on Airbnb and just say, look, if I could own Airbnb down here, I would. I just don't know if we all of a sudden start to see softer job market, continued jobless claims going up, initial jobless claims going up, non-farm data that comes out tomorrow. If anything starts to paint a rougher economy, hotels are going to get hit pretty hard. Stays, vacations, like that gets hit hard. I'm just going to watch Airbnb. I don't mind like buying this thing super, super low. I could probably put in a ratio spread on this one. I don't know if the premiums are good, but could I own this around like $80? Maybe. Let's go out to maybe the end of the year. Let's see what the premiums are to the end of the year. I could do a ratio spread at the expected move. Let me see if I can do an 85 by 80. And I have a $5 profit trap there. If price goes up, hooray. That should be an easy win. But I'm also out, to the end of the year. It's going to take a little bit more time to do that one. So if I went 85 by 80, I mean, that is a pretty good trade. Like $1.82, it's income. I wouldn't mind owning the stock, a 30-day option for a repaired covered call if I needed it. At the monies are $6 or $7. Ivy ranks pretty high. I think I could repair it if I needed it. I don't want to go out that far though. Let me see. Let's go out 78 days into July. Try to price this thing out the same way. 85 by 80. Yeah, these premiums really, really die off. That's tough, man. With earnings coming up especially, let me see. $85 by 80. 182. 91% chance of profit, not a bad trade. Would I own the shares? The break-even spot, if I own them, would be I'd be assigned to 80 minus a $5 trap minus $1.82. I'd own shares at 73.18. I mean, this stock has been around since 2020. Lows back in a bear market in 2022. Right after that, in December 2022, around $83. I'd own it at 73. I mean, I'd own this lower than. I do wonder. I don't think it's a bad trade. We've had some earning misses. There's going to be some volatility, but I think for an income trade, it looks reasonable. So I'm going to take it. Let me see if I can get a $1.90 for this one. $1.90. Not filling for $1.90. That's below the mid price. $1.89. No. $1.88. Come on. $1.80. $1.80 is like the lowest I'm going to go in this trade. $1.85 for. And I say that, and I'm probably going to fill it at $1.80. $1.83 not filling. $1.82. $1.81. Now it's down to $1.70. Well, that's way different. Now I'm above the bid price or the mid. What the heck? Let's try $1.75. Final offer. If it doesn't take it, I won't take the trade. It did. Yes, Larry, it was. It was. It just got posted. All right, $1.75 on Airbnb. So that's going to go in to some of these accounts. Got it filled. Got it filled. This one's got enough. Okay. All right, $1.74 on that one. So new trade for Airbnb. This is a 116 expiration. Buy the 85 put, sell the 80 put. $1.74 credit. Willing to own. If I own the shares, see 80 is the assignment, minus 5 minus the $1.74. Break even will be 73.26. Okay, so down here, new trade. So I'm going 116. So that break even would be 73.26. And this would be all the way down here at 73 and change. So all the upside, pretty minimum risk, about a 91% chance of profit on the trade. Assignment's unlikely, but still, if I owned it, I've got to be willing to own it with that ratio spread. If price goes up, if Airbnb heads up higher, then this $1.74 is probably trading for, let's say 30 cents debit or less. I'll just take the profit, move on. All right, that is that. New trade in for Airbnb. Oops. So it's going to get those added in. I would say, 74 debit or lower to close and move on well before expiration. Okay, then update a screenshot here. All right, and edge. So adding these in. Okay. Trades in. Is there a list of these trades? Yeah, I mean, project options ads, I'm taking it. And newsbreakers service, I'm taking it. So if you're in those alerts and services, they'll be posted through Telegram, in those classrooms, SMS, emails. That's where all the stuff's being shared. Calculating the probability and put ratio. It's right here in the broker platform. So if I look at this trade, Tasty does a good job of breaking this trade down based on the option prices. So right now, the 80 strike going out to January based on the expected move is a 9 delta. So roughly speaking, that gives me about a 91% chance profit on the trade. There's a 91% chance this trade will finish out of the money according to this current environment. So, IV rank is a little bit higher. I'd say on average, we're seeing most stocks in the 30s, 30s and 40s. This is slightly elevated. We have, a bit higher volatility going into earnings this week. So I'm also taking advantage of that hopefully the expected move is actually greater than the actual move, but I know I've got a lot of time in the trade. So I'm willing to own the shares. If you don't have the cash to own it, then the $80 put, by the way, if you sold the $80 put, you're getting $2.75 credit for that trade. So if those two puts, there's two puts there at 275. If this grows to, I would say, 550 would be 100% stop loss. Or if it grows to 825, that'd be a 200% stop loss. If you have no intention of owning the shares, there is your management on cutting off the trade. Right? Because if all of a sudden, like Airbnb were to drop to $50 and you get assigned and you don't have the cash to get the assignment or repair the stock, like if I get assigned, I'm going to take the shares, add covered calls, and flip it for a couple bucks of income. If I don't get assigned, I'm just going to turn this $1.74 into hopefully, $125, $150 of income. But if you're looking to manage a ratio spread, if it hits about 200% of the premium of your put side, you can dump that trade, and that way you're only taking on the risk of you pull in $1.74, you dump it at an 825, so you get out at, let's say, 825. Your net result is what? You're looking about like $5.50. Is that about right? Or $6.50? So 650 is going to be your max loss. So on this trade, you lose about $650. Worst case scenario. But you're standing to make about 174 if you want to let it go to expiration, or even 70, 80% of that max credit with about a 91% chance of profit. So probability to your break even. I mean, probability of profit is 91%. Break even is $73. I mean, 73 is like maybe a 5 or 6% chance it's a sign. Because and again, all I can base it on is my option chain right now. So a 73 break even is going to be a 6 rate delta according to this current option chain. So I've got about a 5% chance of assignment risk. If I'm going to take on any heat as far as owning the shares, about a 5% chance risk, where I'd get assigned, and then do I have the cash to cover? In this case, it set me back. I'd own the shares at $73 in a margin account. I would have 100 shares, which is $7,300. Right? And cash, I have a margin account that's going to be about $36.50 in margin. I've got plenty of option buying power and stock buying power to handle that. So that's why I'm taking the trade. I can repair it. Going out 30 days, you get about $6 or $7 on a covered call. So hopefully, if I had to, I can sell a $73 covered call, try to get $5 or better for it, and flip this thing for a quick income trade, and just calculate my break evens. Make sense? So yeah, Airbnb. I know they have earnings this week, but IV rank is a little bit higher. I'm not playing the earnings game here. I could, but I'm not going to. I'm going to go out a little bit farther because I've actually made some good money on Airbnb over the years. When we first launched and we had these lows, I started to entertain this area to come back to resistance. This support become resistance. I made some money there. We had a double bottom. I made some money there. I never had the opportunity to buy back in. So that's essentially what I'm doing with this ratio spread is, if we're going lower and have resistance here, or we obviously go higher, like that's easy money if it goes up. If it goes down, I mean, I wouldn't mind flipping this thing at new, 5-year lows. I mean, I would think there's some resiliency built into it. Airbnb is a household name. You got VRBOs, you got Airbnbs, you stay in hotels. I think it's a pretty household name at this point. And people that have real estate have turned, instead of doing like, tenant rentals, they've just turned destination places into Airbnb rentals. And I mean, it's a whole business. People have, again, it could all change if like we have a huge housing bubble that bursts and all of a sudden people are dumping. But if you sell, I mean, if you sell your home, it's like I don't think people are going to be dumping for losses after the equity that's been built into it for the last 4, 5, 6 years. So thank you, MP. I appreciate that comment. That's very nice. So, all right, that's Airbnb. I've got to bounce here in just a few minutes. I got a call coming up at 4 p.m. Anything else on the day? Overall, like price action, pretty quiet today. Here is the actual day. So we gapped up, all excited post Meta Microsoft. The actual market itself didn't do much. So we had this was a ridiculous close yesterday. I did, if anyone watching here is not in my daily profit play, I did review my trades from yesterday. If you're watching my final hour, I was literally watching. You're like, you've got to be kidding me, because that market ripped up like 1.2% in the final 20 minutes. I thought it was really silly, because you don't see that happen very often. That was a 1.27% move. It did come back and settle, fortunately, where I needed it. I needed price to stay below 55.70, and it looked like it cash settled per Tasty trade around 55.69. So at the end of the day, I had a couple of winners that added up nicely. I had a 40-cent winner. Well, actually, I did this earlier. So in the morning, I had a broken wing butterfly. That was an 80-cent credit and closed for 40-cent debit. So I took a nice little winner there. And then I had a bear call spread for 45 cents. I had a bear call spread for 55 cents. I had a broken wing butterfly for 75 cents. And I had a regular butterfly spread as a hedge for 10 cents. So this was a loss. This one was a win for $1.75. This one was a win for 55 cents, and this one was a win for 45 cents. So I did lose the 10 cent on the butterfly spread. That was up to 5,600, but the winner on the day, and this was cash settled after fees and everything, it was like 240 bucks. So I made 40 and 45 and 55 and $1.75, and I lost 10 cents, but it was on 3 contracts, so I lost $30 there. So 285 minus commissions and fees, it was about $240, $45 when it was all said and done. So it was more trading than it needed to be. I literally said this in Telegram with my daily profit play service. I'm like, I don't want to call a top today. And here I was watching price in the final, literally the last like couple of hours. I'm like, I don't think we're going to come back and fill this gap today. This seems like a pretty, little did I know, freaking market rips up, it was very close, right? Like it was very close from this, little $240 combined winner to risking $2,000 on the day. So I was very fortunate to come out of there with wins. But it was down to like, if you watch yesterday's session, if you're here live with me, it was literally the final like 2-3 minutes. It took it all the way into the close, and it was a wild ride, and that's not fun. And here we are, the final few minutes of the day. What's happening today? Well, market's right back where it started. So this is where we opened, and we're right back to it. Is there going to be a gap fill going into non-farm tomorrow? I am not super bullish at these levels. I've talked about this pretty much at length the last couple of weeks. Is the market has given us all a chance to de-risk and de-leverage. I understand that the market might melt up, and that power is beyond me, and this could climb the wall of worry. But my gosh, man, from this low to this high, I don't know how we can all of a sudden fundamentally justify the market being at all-time highs. The trade war is not resolved. Inflation is around. It's not gone. The Fed is likely going to cut rates, but that's the big debate, because the thing that's not dropping, by the way, is this. This is what's not dropping, everybody, right? Liberation Day 10-year yield, Scott Bessent, Donald Trump, Howard Lutnick? All of them are celebrating, hey, we're below the 4 handle on the 10-year, and then we freaking broke the bond market. And that was the put on the 9th. Like Trump put was like, hey, we're tweeting out Truth Social, 90-day pause on tariffs. The market ripped like crazy. We are not below the Liberation Day yields. That's a concern. I think that this is probably going to be the stickiest thing. And when the Fed starts cutting, I do wonder what happens. This is when the Fed cut last year and the bond yields went up. So I have to wonder, just like I'm sure everyone else is, when the Fed starts cutting this year, if they start cutting this year, are we going to see higher yields? Because if that is the case, That is the big liquidity refi air pocket that everyone is talking about. That's probably not a good sign. And this is why I think we could have a housing bubble. Because if nobody can buy a freaking house at 7.5, 8%, and prices are as high as they are, something's going to break. And this is exactly why on the screen, as we wrap up today's session, I've asked this question before. I asked people this week, are we going to hit all-time highs, or are we going to hit fresh lows or retest the lows? Which comes first? And right now, a lot of people are saying retest the lows, which to me fundamentally makes more sense. But if we hit all-time highs, I think we're going into another asset bubble. And anything can happen. And the stock market doesn't have to reflect Main Street, doesn't have to reflect the real economy. The stock market's funny money, and it's just the market. You trade it. But what I'm talking about here is this is another poll. What do you think is going to happen? House prices come down or rates come down? I think this is the least likely to happen. I think rates coming down is the least likely to happen. I think house prices coming down will probably be the reality because everyone thinks their home is worth 2 to 3 times what it was 5 years ago or 10 years ago or whenever they bought it, which is amazing to think that your house is worth 3, 4 times what it's worth. Okay. But the fact of the matter is, house prices have appreciated over 17 years more than the entire stock market performance. If you parked money since 2008 into the S&P 500, you're underperforming what your home is worth right now. And that is insane to me. So if rates don't come down to make the housing market more affordable, unfortunately, I think that home prices are going to come down probably by 20 to 30%. It doesn't mean it's a housing crash, but we have supply side that's catching up to hopefully offset some of the home prices. But obviously, if supply side catches up, people that are sitting on the market with their homes now that maybe want to sell can't sell for what they think. They can't sell for top dollar. They've got to sell for a compromise. And that might be, 10, 15, 20% off of what they think their current sticker price is. Okay. Donna, have I changed it? Do I ever change it? No, it's still the same Discord. My Discord is still Chris Pulver Trading, the exact same thing. I mean, the channel. These are all my channels right here. Has anything changed? Test for real members. Okay, everyone in my Discord. There you go. That's me. That's me. Live Discord, my channel. Right? Will the market rally on Fed cuts then? Possibly. But honestly, like if the yields don't go down, this is a huge crux. If the yields don't go down, I don't know how the stock market can justify higher highs. It's like that is a ticking time bomb of refinancing and debt that gets really, really messy the second half of this year. So, I mean, I this is why I think if we do rally to all-time highs, I don't think that's the higher probability, but if it does happen, I wouldn't fight it right away. I wouldn't just sell the top, but my gosh, would I be looking for a topping pattern over the course of maybe 5 to 10% of all-time highs? I would probably be looking for like another crash to come. So just, I don't know. It's just head on a swivel. You got to be prepared. This market's not going to be easy. This is going to be a trader's market and a trader's year. The only thing that I'm certain of is there's going to be a lot of volatility and a lot of uncertainty. That's what I'm certain of. So I'm doing my best. I mean, right now, I just did the math this week. It's like I'm back up to about 54% of my account in cash. I am patient. I am annoyed that it's like I don't really have a lot of great trades that I want to just jump in now. I was really aggressive through the drop in April. I was hedged out through Q1 and through that drop in April. So I mean, I did battle the markets pretty well. I've got a lot of accounts up double digits right now, which I'm happy with. But I have cash at the ready and plenty of buying power. I just need to find what I think are good opportunities. And if I don't find like good medium term opportunities, like I'm just going to income trade. I will income trade, and I also will buy some shares and sell some calls, and buy some shares and sell some calls, and be a trader and generate income, and that's okay too. I don't have to pick like the perfect swing, and I don't have to pick the perfect direction, but I can certainly use options to generate some income. So to answer your question, Jonathan, like I don't know, man. I honestly, I mean, this is the big like wild question: is like, will the Fed even cut in 2025? I mean, they probably will or should. But I also wonder if them cutting into, I mean, if you look at the Fed funds rate, and I've got to go here in just a few minutes, I'm going to have a call coming in here. But if I go to the Fed funds rate at 4.3%. What I want you to pay attention to is how has the market performed every time we've seen a consistent cutting cycle, right? Consistent cutting cycle. How's the market performed in those windows? And I know this time might be different, but in 1989 to 1990s, did the market perform well during a cutting cycle? No. How about in 2000, 2001? Did the market perform well in a cutting cycle? No. How about 2007 and 8? Did the market perform well in a cutting cycle? No. How about going into COVID? No. COVID was the excuse. It was already happening fundamentally behind the scenes with the Fed cutting. So we've made the cuts last year and we kind of softly, soft landing slash navigated, thread the needle, whatever you're going to call it. But cutting more into this, what is different? What is different about this market that goes back to all these windows where the Fed has had these really large easing cycles and the market's going to stay at all time highs and keep making all time highs? I don't know. Lee says, I don't think the Fed will cut until after the 90. I mean, maybe, but probability right now is pretty high. They're going to cut in June. If they push it back to July, I don't think the market's going to like that at all. I don't think the Fed needs to make decisions based on tariffs because reality is this: the tariff trade war talk is so disruptive that the Fed shouldn't even be thinking about that as far as monetary policy. But they probably will. The Fed is going to go back to their simple mandates, which is employment and unemployment rate and percentage and keeping the market stable with price action liquidity, right? I mean, they don't want to cut rates, but they probably have to because short term is what's funded this market the last 3-4 years. But I mean, the bond market is pricing in very aggressively bad things. If yields don't go down on the long end of the curve, that's not a good thing for anybody that's looking out 5 years, 10 years, 15 years, 20 years. And this, ticking time bomb of debt. If the U.S. can't finance itself anything long term, I mean, the only thing that's attractive is short term treasuries. So everyone getting involved in the U.S. Treasury market, and whether it's domestic or international, everyone in the U.S. market is buying short-term Treasuries, right? And that way you just turn it, you burn it. But short-term is going down, and long-term is sticky, and I think long-term yields possibly go higher. So it's going to make debt more attractive, but it does potentially bring in like this is what emerging markets do is they make their longer term debt more attractive on higher yields. And I don't want to see the US trade like an emerging market. I don't want to see this trade like, Argentina or Turkey or, I mean, countries that have been like on the brink of like hyperinflation and bankruptcy. I mean, I don't know. I don't think the US hopefully never gets that way. I think we're too big. We're too sophisticated, I think. But nobody is perfect and nothing is immune. Okay. So anyway, I got to run. I'm going to bounce and I'll be back and come to do this tomorrow. Imposter. Yeah, that's what I thought. Index is declining. New Trump tweet. I don't know, man. I mean, it was just a little dump towards the end of the day, so don't think much of it. We'll see what happens tomorrow. Non-farm payroll tomorrow morning. So if the market is, down on the day, it could be non-farm numbers. We've got Amazon, Apple after market, so it could be, some surprise news after hours today. We'll see what happens. I'll come back and see you tomorrow. All right. Thanks. Bye.